with the stock market going down and hitting recent lows. So today I want to look at inverse S&P 500 ETFs and also inverse Nasdaq 100 ETFs. And I'm going to compare inverse 1 times to 3 times leveraged inverse ETFs also and see how well they did. So the first one I want to look at is the ProShares Short S&P 500 ETF, also known as SH. That's the ticker symbol. If we look at the return here, you can see it. This one basically tries to match the S&P 500's return, inverse return, on a daily basis. They're not trying to do it over time. So the results are going to be best on a day-to-day basis, not over a long term. And that's kind of what I want to look at. This one has a high 0.89% expense ratio. And I'm going to compare this to the Direction Daily S&P 500 Bear 1-time shares ETF. Now this one is a little bit newer. The other one, SH, the inception date was 2006. This one, the inception date is 2016. And this one has a much lower 0.47% expense ratio. So let's see how that lower expense ratio does. It says right here on the ProShares website, for any holding period other than a day, your return may be higher or lower than the daily target. These differences may be significant. Smaller index gains, losses, and higher index volatility contributes to returns worse than the daily target. Okay, so here we have the ProShares Short S&P 500 1 times, minus 1 times, right here in blue. We have the Direction Daily S&P 500 Bear minus 1 times. This is the one with the lower expense ratio. And let's select the 1 month period. Okay, so I've selected the 1 month period. This is the total return. This is the S&P 500 here, SPY. It's lost minus 7.69%. And as you can see, the returns are pretty much inverse. It's basically like you flip this upside down. So through February 28th, we can see a 4.38% return for the ProShares and a slightly higher 4.55% for the Direction SPDN. Meanwhile, the S&P 500 minus 4%. So it actually did a little bit better than the S&P 500. So rather than returning 4.04 positive, it's a little bit higher. And if we go down the list here, we see pretty similar, minus 5.39, 5.992, or 6.05. So they're pretty much inversely related. This is a very short time period. And for the longer downturn right here from March 8th through the 12th, the return is even better, 9.91 and 9.99 versus a loss of 8.82% for the S&P 500. But one thing that I'm noticing is that the Direction with the lower expense ratio here in orange, you can see it's pretty much a better performer so far. So now let's go to a longer term and see how well it does. So if we go to 6 months, it doesn't look like this website gives us a 3 month on this. So we'll just go to 6 months. But if we go to 6 months, also we see the orange here is on top pretty much the whole time. So the Direction Daily S&P 500 Bear appears to be the better performer. So I'd probably say it's the winner. Also, it's cheaper. So for this 6 month period, the S&P 500 is down minus 1.26. Meanwhile, these are up 4.49%, 4.89. And if we go back a little bit more here to February 18th, the S&P 500 was up 9.5%, and the S&P 500 was up at 9.5%, and these were down around 5.97. And once again, the SH is losing a little bit more money than the Direction. So it loses more money and it makes less when it goes up. So I'm going to pin the winner on the Direction Daily S&P 500 Bear 1-time shares. And by the way, this is the smaller of the 2 ETFs. This one has roughly a market cap of $204 million versus about $1.2 billion for the ProShares one. So the next one I'm going to look at is the ProShares SDS Ultra Short S&P 500. This is the 2 times inverse S&P 500 performance. And this is the only one that I could find that's the 2 times. The actually Direction doesn't seem to have a minus 2 times 1. So this one is already the winner for this category. Okay, now I've added the ProShares. I've added the ProShares Ultra Short S&P 500 here in green, SDS. As you can see, the 1 month performance has been much higher than the others, about twice as much. If we look at SPDN did 8.77%, this one's done 17.39, so almost twice as much. If we go back a little bit more, it's more equal. This one here now, if we go back a little bit, when the returns don't go up so sharply, it looks like it does a little bit more accurately. This is 12.38%, and the other ones did about 6.16%. So it looks like it's doing pretty well so far. Let's look at the 6 month. So just in 1 month, you know, up to at one point up to 22% return. Now, if we go back further to 6 months, the returns start to drop. All right, the next one I want to look at is the ProShares SPXU Ultra Pro Short S&P 500. This is the inverse 3 times leveraged S&P 500 fund. And I'm going to compare it to the Direction Daily S&P 500 3 times shares SPXL. Now, this Direction one has a market cap of about 384 million. It's got fees of roughly 0.87%. If we compare that to the ProShares, the ProShares has a fee of 0.89, so very similar. And the ProShares has a market cap of about 400 million. So ProShares appears to be slightly larger. All right, so I've added the ProShares one here in red, and the Direction 3 times one is here in blue. And as you can see, the returns are increased even more. Now let's go back to 1 month. The other one had done 22% here. This one has actually done 34%, 34.99% for the SPXS. And just looking at this chart, I'm seeing that the blue one, the Direction one, appears to be slightly better performing. And it has a slightly lower expense ratio of, I think that was 0.87. So as we go here, this one's returned 18% versus the 1 times. The SH, the 1 times inverse, only did 5.92. So it's supposed to be doing 3 times that. So the one did 6.05, so it should be doing 18, and it's doing 18. So in the short term, they seem to perform pretty well. In the short term, they seem to be pretty accurate as far as meeting that 1, 2, or 3 times return. Now we're at the 6 month. The 6 month returns, you can see it's pretty much like the S&P 500 here in purple is flipped upside down and it's inflated. So the returns are exacerbated. If we look at the year to date, it's showing the S&P 500 is down roughly 3.97%, and the 3 times one is at 13.69% return. So 4 times 3, 12. It's done actually better than the 3 times return. And the 1 times actually done better. It's instead of 3.97 positive, it's 5.36%. So once again, for the winner, I'm gonna crown the winner for the 3 times inverse ETF to the Direction Daily S&P 500 Bear minus 3 times. But don't get too excited. So if we go to the 1 year return and we click on it, we can see that the returns, as the stock market has done pretty well, the losses get greater and greater. And if we go to the 5 year, you're basically going to lose all of your money with one of these inverse ETFs because the stock market goes up over time. So the 3 times ProShares inverse ETF minus 95%. So you've lost pretty much all of your money if you've held it that long. The 3 times one minus 84%, minus 53% for the 1 times return. But as you can see, if they limit the downside. They do some tricks to limit the downside. Otherwise, it'd be minus 125% return. Fortunately, with these ETFs, you can only lose 100%. But these are horrible investment. That is, if you invest in the long term, they're horrible investments. These inverse ETFs are only for short-term speculation. They're not for investing long-term. Now, that's not the only one I'm going to compare. I'm also going to compare inverse Nasdaq 100 or QQQ ETFs. And I'm going to look at all 3 of these are from ProShares. It's the PSQ short QQQ, the minus 1 times. So we're going to look at the 1 times PSQ short QQQ. We're going to look at the 2 times QID ultra short QQQ. And we're going to look at the riskiest one of all, SQQQ ultra pro short QQQ. This is the inverse 3 times return. Now here they have the daily returns on the SQQQ. So as you can see, it's not exactly inverse. It's more inflated up or down. But it's basically like flipping the chart over. And this one day, the market had a minus 2% return. They had a 6.62% return. And this day here, it had almost a 4% decline and almost a 12% return. Now, out of all these, this is actually the riskiest, but also it's the most popular. SQQQ has a market cap of 2.21 billion. It's larger than the others. And SQQQ started in 2010, so it's a little bit more recent than the others, which were 2006. Okay, so now I've added QQQ here in blue. This is the Nasdaq 100. As you can see, it's down. On the 1 month, it's down minus 10.87%. And I've added the 1 times return inverse PSQ, the 2 times QID, and the 3 times here in green SQQQ. And this is on a 1-year return. We've got basically a minus 11% return. And instead of a 33% positive return, we actually get a little bonus. We've got a 38% return and a 24% return for the 2 times and 12 times return for the 1 time. So done a little bit better so far. And just last week, the return would have been 48% for the 3 times SQQQ. Now, if we go back a little bit further to March 6th, the market was down around 7%. So it's pretty consistent here, and the 3 times one was up 22%. Okay, let's go forward a little bit. So we're at the 6-month period now. The 6-month during the 6-month period, the 3 times one got down to minus 30%. Actually minus 32% recently. Actually, in February recently, minus 32%. And then it's basically recovered to a slight profit recently, and then it's gone down a little bit. So if we go forward a little bit more, year to date, now let's go to year to date. Okay, 17.95%. Now let's go forward a little more. Now you're going to see these losses get magnified. So the 1-year return, losses for the 3 times, minus 47%. And the market was up 23%. And if we go to 5-year, you've lost all of your money. Minus 98%, minus 93% for QID. PSQ, you've only lost 68%. Meanwhile, if you kept it in QQQ, the Nasdaq 100, plus 184% return. Now, one that surprised me, now a lot of people use VIX, which is a volatility index. The largest ETF/ETN that you can actually trade that I found is called VXX, the iPath Series B S&P 500 VIX short-term futures. And surprisingly, this does almost the same as some of these inverse ETFs. So if we go back to the 1 month, this volatility ETN, which is actually riskier than an ETF from my understanding, has actually done almost as well as the 3 times inverse ETF, which surprised me quite a bit. So you can see it right here in red. And if we go to 6-month, the 6-month return, it's actually done. The 6-month return, it actually did 16% right here, 16.7. All the other ones were at, a 2% return, and the market was down a little bit. So, and you can see that it has huge swings when the volatility changes. Like right here, it was up 15%, basically very quickly. Now, this is just one, but this is one of the more popular ones. But if we look at the long term, of course, it all goes down over time. If we look at the 1 year, even with the 1 year, it still did better. The 1 year, minus 5% versus minus 26% for the green one, the 3 times inverse. But if you go far enough, you can see here in the red, minus 98% return. So returns don't last forever. So eventually you lose pretty much all of this one. And if that's not enough, let's do a leveraged long VIX, UVIX. Okay, UVIX lost 99% of its money over this time period. But let's go back a little bit more recently. It's here in blue here, plus 42% return recently. As this volatility's increased, it's done better. This is only a two times volatility. It's not 3 times like the other one, and it did 42% return. And if we do the 6 month, it's at minus 16% return. It's actually the worst performer for that one. Year to date, it's the best performer, roughly 36% at this point here versus 26% for SQQQ. But within just 1 year, minus 60%. So very risky. But you can see these huge swings here that these volatility indexes have. So this one swing here, 98% return in basically just a very short period of time. This was from like July to August. So from what I've read, these VIX, leveraged VIX, short-term ETNs, like the 2 times 1 that I mentioned, are probably the riskiest, even riskier than probably the inverse 3 times ETFs. And this one here said that there's one that was actually failed. This Velocity Shares Daily 2 times VIX short-term ETN, TVIX, was actually shut down in 2012. It was issued by Credit Suisse Securities 2010 and was delisted in 2020. So when it says they routinely did 10-to-1 stock splits when the price fell to certain price thresholds. This is basically to prevent the fund, I think, from losing all of its money. But there was a problem with the net asset value. It mentions here in this article that ETNs are based on futures contracts and the price decays rapidly. This was not designed to be held for extended periods of time. And they go on to mention that basically ETNs do not have tracking errors like ETFs, but unlike an ETF, the pricing is not as accurate. So the price of the underlying ETN may be way overpriced or underpriced, unlike an ETF. Short-term ETNs are riskier than securities that have an immediate or long-term investment objective and may not be suitable for investors who plan to hold them longer than 1 day. They mentioned this disaster here in 2012. They had pricing errors, the price erosion of 80 to 90% annualized. The market price was as high as 90% above the net asset value. See, that would never happen with the ETF, but with these ETNs, it's not structured to where the net asset value is close to the market price. Then in March 2012, it collapsed 30%. It collapsed 29% and 29% the following day. It fell from $14 to $7, over 50% in 48 hours. So that shows you what can happen with these volatility ETNs and the delisting here. So should you buy inverse or short stock market ETFs? Well, this is not an investment. These are basically just speculation. So this is basically not an investment. This would just be speculation. So if I were going to do something like this, I wouldn't put much money because over the long term, you basically lose it all. But if you're worried about the returns going down in the short term, it may be useful at times. I hope you like this video. If you like this video, please make sure to give it a thumbs up, like, and subscribe. Have a good one. If any of you want to try Moo Brokerage, I'll put a link in the description. Moo is a no commission broker where you can trade on your smartphone or desktop. It has a fairly advanced interface, advanced charting, quick trades. You can do back testing, and it has very competitive rates. And you get up to 30 free stocks and 8.1% APY for the first 3 months on your uninvested cash. All you have to do is click the link below, deposit at least $100. You'll get 5 free stocks, 8.1% APY on the uninvested cash for 3 months. If you want to deposit more, you get up to 25 free stocks. Offer ends March 31st. So look for that link below.